Welcome back to the Deal Mastery Insider. Today, I want to unpack SBA loans and how they work, because the reality is, whether you're an existing business owner or a searcher, an acquisition entrepreneur, if you're thinking about buying a business, there's a pretty good chance that an SBA loan is one of the fastest and easiest ways to get that deal funded. Now, there's pros and cons to doing an SBA loan, and I'm not necessarily taking a stance on whether I think they're the best strategy, but I think it's a really common strategy and oftentimes one of the most viable strategies for getting deals funded. And so I wanted to just unpack and show you some math, roughly how SBA loans work, and talk about a couple of the key things that might drive an SBA loan or make it work or not work for a particular transaction. So with that, let's look at a couple of the scenarios I've mapped out here just to give you a sense and kind of show you how I think about SBA loan financing and where you may want to avoid or pay attention to things when you're looking at a deal. So for starters, I've mapped out 4 different scenarios. They're pretty similar, but we're going to play with them and make them look a little bit more different. But to start, I've got the same business with $1 million of EBITDA. And I've got a purchase multiple ranging from 4x to 5.5x to show you how viable or not viable SBA financing might be given your purchase multiple, right? And the nice thing about SBA 7A program is that you can get 90% financing for a deal. In some cases with the seller financing, you might even be able to get 90% finance and only have to come up with a 5% down payment, which is pretty massive, right? You could buy a $5 million company for putting in a couple $100,000, which is huge. And as you can see here, depending on the purchase multiple, can actually generate a pretty substantive return on invested capital even after reinvesting a pretty meaningful amount of money in the business. But without understanding that, you can also put yourself in a situation where just because you can get 90% financing doesn't mean you should, and you might be over leveraging the business because you're paying too much for it or you're putting too much debt on it. And so that's why I wanted to look at these scenarios. To start with, what you can see is the bigger the purchase multiple, and this shouldn't be that controversial of a perspective, but the bigger the purchase multiple, the bigger the price, which means the more total financing is on the deal, right? So if we have a business that's doing $1 million a year of EBITDA, and we buy it for $4 million and we get 90% financing, that would be a $3.6 million loan balance, right? Assuming we don't have any kind of seller financing or seller carry or anything like that. Now, if we buy that same earning stream at a 5.5 multiple, we'd be paying $5.5 million, which means we'd be taking out a loan that's almost $1.5 million bigger. We'd be taking out just under a $5 million loan, right? We wouldn't need to come up with that much more equity. We'd only need about $150,000 more equity. But as we can see, our cash flow would get constrained pretty meaningfully. So just to walk you through this model really quickly, it's pretty straightforward. We've got our EBITDA, our purchase multiple, which gets us our price. I've made an assumption here for deal expenses, which is just a placeholder. You can increase it or decrease it, depending on what you want to spend on legal and QV and lender fees and so forth, which gets us to our total transaction size. And then we have the loan LTV, which is just 90% of our total transaction size, which gets us to our loan size. Right now, I've got 0% seller financing, though we'll play with some scenarios where we have seller financing just to see what it looks like. And then that gets us to, we have a rate, and obviously rates have recently been reduced and may decrease further, but I think this is still a reasonably conservative assumption for where an SBA loan might price today. And then we have a 10-year term, which is a typical amortization for an SBA loan. That gets us to our payment calculation, which is just taking the loan balance, the rate, and the term to get to our annual debt service. And then our free cash flow is our EBITDA minus our debt service, gets us to our remaining free cash flow. And then we also calculate this thing, you may have heard this, it's called DSCR, debt service coverage ratio, which is basically giving us a sense of how much our debt service is in relation to our cash flow or relation to our EBITDA, right? So in this case, it's basically saying, hey, sorry, I said that in reverse. Our EBITDA is 1.6 times our debt service, right? Just see that. Just EBITDA divided by debt service gets us 1.6. Typically, SBA lenders will want to see a DSCR north of 1.5x. Sometimes for a given transaction with the right collateral base, with some other factors at play, they may go down to as low as 1.25x, but you'll rarely see a deal that will go below 1.25x from a debt service coverage ratio standpoint, which basically means you want to have EBITDA that's at least 1.25 times your debt service. And as you can see, once we start to get to a higher purchase multiple, we start to go under that number, which makes the deal potentially much harder to finance. So just something to be thoughtful about. And then I've made an assumption here as well that we're distributing 50% of our free cash flow. And that basically means if the business, after we make $1 million of cash, we give 600 back to the bank to pay our loan. We have 400 left over. What do we do with that? Well, I'm saying, hey, we're going to take half of it and we're going to leave it in the company or reinvest it. And we're going to take half of it and we're going to distribute it out to the owners, right? And so in this case, if we had an equity investment of $400,000, which is just our transaction minus our loan balance, and we distributed just under 200K, we'd have about a 49% cash on cash return year one, potentially, right? If we make $1 million, we pay 600 to the bank, we keep half in the business to redeploy, and then we distribute half, we'd have about a 50% return on our capital, which is awesome. And so this is kind of the 4x purchase multiple scenario. And as you can see, when you buy a business for a lower multiple, and you put a smaller loan on it, you have more cash flow, you have a better debt service coverage ratio, and you get a better return on investment. Conversely, when you buy a business for a 5.5 times multiple, or a bigger multiple generally, not only do we have much more of our cash flow getting eaten up by debt service, because remember, it's the same amount of cash flow regardless. Our loan size is much bigger. We don't have much free cash flow left over. Our debt service coverage ratio starts to go below the threshold where lenders are comfortable, and they may not even let you have that much debt on the deal. And our returns on invested capital, if we're distributing this, go way down, right? And in fact, if we decided we wanted to keep back 200K, let's say, to reinvest in the company, in this scenario, we might actually distribute zero, right? Because in reality, we need to hold all that back to reinvest it in growth. And so if nothing else, what I want you to take away from this is two things. One, SBA financing at 90% is phenomenal and helps you get very close to crossing the finish line in terms of getting a deal funded. But even SBA financing reaches a breaking point at, depending on what your assumptions are around rate, because the term is almost always 10 years, depending on what your assumptions are around the interest rate on the debt, it's really capping out at if you're assuming a 1.25 DSCR at, like, you can't really buy a business for 5.5 times and put SBA financing on it at this rate environment and have it pencil for lenders. They'll basically say, hey, that's too much debt. We need to cut it down to where the debt service coverage is more reasonable. If a lender's paying attention to DSCR more aggressively and they want it to be closer to 1.5, you may only be able to pay 4.5 times for the business if you're using SBA. And we can also just use this as a case study to look at the rate impact. So if we say, okay, well, rates are 11, give or take today, what happens if they're, let's say, 9, right? Well, in that scenario, our cash flow goes up a little bit, our debt service goes down, and our DSCR gets closer. It's still maybe not all the way there, but it's getting better, right? And so maybe now we've at least crossed over 1.25, and maybe we can get a lender more comfortable with that. So just showing you what the rate impact is, I think, is really interesting. But if nothing else, I hope you take away how SBA loans generally work, how they're structured, and how you can use 90% financing to fund a deal without having a huge equity need, and what the impact is on a higher purchase multiple in terms of reducing your ability to cover your debt and thus reducing your ability to pay for the deal. This is why you typically want to try and negotiate a lower purchase multiple, because if you're going to use SBA financing, you're going to be better off. You're going to have better debt service coverage. You're going to have more free cash flow if you pay a lower price. Now, that's easier said than done. But there's also, I think it's really helpful if you think about the constraints on the market as a whole for certain deal sizes, especially deals that are targeting the $5 million SBA loan size. There's sort of a natural cap in the market around this purchase price because anybody using SBA financing is going to have the same constraint that you will in this scenario. There's a couple other things to think about when we look at SBA loans, and there's a lot more to unpack here than I can cover in this quick newsletter. But for starters, there's some really interesting stuff that's been changing around the SBA. For a long time, it had really specific constraints about what you could and couldn't do. Some of those things have started to change. There's a new program called the SBA Pari Passu program, which is actually letting lenders get up to $7, $8, even $9 million of total loan proceeds with SBA, which can get really interesting for larger transactions than SBA is typically applied for. There's also some really cool stuff. SBA recently had a ruling that the NAICS code, or the NAICS code, which is basically the industry description code for a given business, you can now get a $5 million 7A loan for each NAICS code, which basically means you can use SBA 7A for every potential transaction that you do, whereas before you used to have a global cap of $5 million. So there's some really interesting things. There's also a few changes around SBA starting to become more receptive to seller financing, rolled equity, and some more seller flexible structures, whereas SBA used to not play nice with any of those things. So SBA is a really interesting source of financing. If you're looking at buying businesses, whether you're a business owner or a searcher, it's a really, if you don't understand it, it's really kind of the most straightforward, plain vanilla, down the middle method of acquisition financing. It's where most folks start, and the average deal is probably going to use SBA. So getting to know it is really helpful. Hopefully this gives you a sense of how SBA loans work and how they fit in with financing a deal. If you need help getting an SBA loan, hit me on this email, reply back. I have a bunch of lenders I'm happy to connect you with, and open up my Rolodex and help you find some funding for your deal. But either way, if you're not looking at SBA, it's a great tool and a great resource to understand as you look at funding and financing your acquisitions. I'll see you in the next Deal Mastery Insider, and thank you for being a subscriber.